The broadcast is now started.
Hello, welcome everybody to today's webinar titled Dealing with the Australian Dollar in the Year Ahead. It's brought to you by Commonwealth Bank's Total Capital Solutions. My name is James Kirby, Managing Editor of Business Spectator, and I'll be your moderator today.
Muted.
Hello and welcome everyone to today's webinar titled Dealing with the Australian Dollar in the Year Ahead, brought to you by the Commonwealth Bank's Total Capital Solutions. I'm James Kirby, Managing Editor of Business Spectator, and I'll be your moderator today. And what a great day it was to choose for this webinar, because it is very much a day where the dollar is in the news. Now, our Australian dollar is always in the news, and we know actually from our own service here at Business Spectator that it's the most searched word on our site. But today, of course, we see that the dollar is reaching something of a low, a 13-month low against the US. This brings it into the news, and of course, I think on the wider area, our readers and viewers are beginning to realize that the forecast for the dollar is certainly changing, and we see some changes in the markets, we see some downgrades in the market, and we see some activity around Australian dollar trading and the wider context. So I think it will be a very interesting session. Now, while we're waiting for the last people to file in, I'll run through some quick housekeeping. First, to keep the note-taking to a minimum and interaction to a maximum, we'll be providing you with a link tomorrow to the recording of this live session. So take the opportunity throughout the webinar to write the panelists a question by using the control panel on the right-hand side. And as always, we'll do our best to answer all the questions you ask, but it may not be possible to respond to each and every one in the session, so apologies up front for that. Okay, well, let's get started, and we'll introduce first of all our two guests today. We have with us Jim Vrondas, who is the Head of Client Dealing at OzForex, and we have Greg Gibbs. Greg is the Senior Currency Strategist at RBS. And Greg, you are the lucky man who is going to begin the presentations for us today with a short presentation, your call on the markets. I think Danny has the slides ready. So Greg Gibbs, Senior Currency Strategist at RBS, if you'd like to begin your presentation. Thank you.
Okay, thanks very much. Well, the first chart there I have basically put in a few lines, I guess, to look at how Australian dollar is tracking some key variables related to global growth or industrial activity. The bright pink line, first of all, is the global PMI or manufacturing index. It peaked early this year. The first quarter of this year has been coming lower for a good part of the year, and at the most recent level in September is trading at its lowest rate since middle of 2009. So we have seen a significant, I guess, fall in the global growth expectations. What impact has that had on metals, industrial metals? Well, the orange line is the base metals index on the LME, and that has fallen sharply quite recently, as has the Australian dollar. You can see the two do tend to move in line with each other, or certainly have over recent months. However, the blue line there is iron ore prices in China. So that's obviously our major export item, and going to our major export partner, China. And you can see that there's been only a small rise, a small fall in iron ore prices recently. So it hasn't really impacted too much on China yet. But certainly there is some evidence there that the global economic outlook has been going through a downward revision over the course of this year. Moving on to the second chart, and what I've got there is the indication of what the market's expecting for interest rates in Australia. So you can see that where the cash rate currently is 4.75%, 1 year ahead the market's currently discounting that cash. A similar scenario to happen in 2008, where the RBA slashed interest rates during the meat of the global financial crisis. So what you're looking at there is the market's actually factoring in a very large echo of the global financial crisis in 2008. At least the interest rate market is, and that certainly narrowed the interest rate advantage of the Australian dollar over other currencies over the course of this year, and quite dramatically really in the last couple of months. Moving forward to the third chart, I've got a chart there looking at the Australian dollar compared to an index of Asian currencies. Now the index of Asian currencies is the red line, and you can see that the Australian dollar has been trading in a fairly correlated fashion with Asian currencies, particularly over the last couple of years. And you can see in the last month there's been a very big fall in Asian currencies. Likewise, there's been a very big fall in the Australian dollar, and the blue line at the bottom is an index of the US dollar against other major currencies, and it's rallied sharply. So a large part of what we have seen in the Australian dollar in the last month reflects a broad-based rise in the US dollar, and it's been filtering through to those Asian currencies and the Australian dollar. And then we'll go forward again, we'll move through this chart. Third chart is a look at financial equities in the global economy. So we're obviously talking, one of the major events which is impacting markets at the moment is the European financial crisis. And you can see from the yellow line in that next chart of European bank stocks, they have fallen sharply through the course of this year, particularly from around middle of the year. They fell quite sharply. But more recently, the red line is Chinese financial shares. You can see that more recently, over the last month, you've had quite a sharp fall in Chinese financial shares. And I guess that's adding to the concern for global markets. Well, you've got a financial crisis going on in Europe at the moment. There's certainly some fears developing over the banking sector in China as well. Its exposure to the property market, its exposure to local governments, and the bad loans which are potentially developing in China. Now, it's a very opaque story in China. We don't know too much about the details, but certainly the market is fearing a degree of financial stress developing in China as well. And then the final chart I have, second to the final chart, the next one, is looking at the stress in the banking sector. Now, there's been a noticeable pickup in the stress in the European banking sector over the last couple of months. Really, it peaked. It started to turn lower from around the end of April, but around about the end of July, it increased, and then again over the last couple of months. And the orange line at the top is a cross-currency interest rate basis swap between the euro and the US dollar. And what it's telling you there, it's kind of like the additional cost that European banks would have to pay over and above the US dollar one-year rate to obtain US dollar funds. So as that orange line at the top panel starts to fall, it tells you there's stress in the European banking sector. The blue line at the top is the difference between 3-month US dollar interest rates and the expected cash rate in the US. You can see that's also been rising fairly significantly for the last 2 to 3 months. Again, another sign that banks are more reluctant to lend to each other. And the bottom panel looks at the euro currency against the US dollar and the Australian currency against the US dollar. You can see as that funding stress was increasing, both those currencies were coming under pressure against the US dollar. So similar to what happened in 2008 when there was a global financial crisis, we saw the US dollar strengthen broadly as a result of US dollar funding costs tending to rise. And we've seen similar kind of events again recently, and that's contributing to a big part of the fall in the Australian dollar. So looking ahead from here, really what we're looking at is we have to resolve the global financial, or this echo in the global financial crisis if the Australian dollar is going to stabilise. And the principal cause of that, of course, is this crisis in Europe. Now, as long as that crisis continues and the policymakers in Europe are unable to get ahead of that, we continue to see banks in Europe reluctant to lend to each other, or other banks lend to European banks. It's going to continue to tighten up global financial conditions and continue to raise the effective borrowing costs for US dollars. Now, central banks are trying to counter that by adding additional liquidity to the market, but over the last couple of months, the fear of this financial crisis has overtaken the actions of the central bank, and hence we're seeing the Australian dollar come under pressure. I don't really see that pressure being eased through the rest of this year. In fact, I can see it continue to intensify. There's so many things left unresolved in Europe, including whether whether Greece would get its next tranche of its bailout money or whether it will be forced to default, and whether they have the capacity to then build a firewall between Greece and other countries in Europe. There's so much uncertainty there that I think the Australian dollar can remain under some downward pressure. And as those previous charts showed, while this financial pressure is going on, we're also seeing concerns over the Chinese financial system, and we're also seeing some downward revisions to global growth. The combination of all those factors is keeping markets focused quite short term and uncertainty high. And in that environment, you'll probably see the Australian dollar continue this downtrend that has been established over the last couple of months into the end of the year. Now, our recent forecast of the currency was at 93 at the end of the year, maybe improving a little bit towards Q1. Next year it's back to 95. From there, I have been forecasting a recovery, but much depends on the market's focus returning back towards those longer-term structural positives for the currency. Now I'm going to pause there and allow our next speaker to speak.
Thank you very much, Greg. A terrific presentation. And I would say to some of our audience today, if you are having some trouble with the graphs or accessing the graphs, that should be sorted out soon. And we will, of course, be sending links to these graphs, and you will be able to receive them later in any event. So thank you, Greg. And some of the issues you brought up are, I can see from the questions on the screen, are prompting a range of questions. Some of the issues you mentioned, including obviously the ongoing European situation, the difficulty of getting a clear view of China at the same time, our role here, and the operation, if you like, of our dollar, how that actually pans out in the weeks ahead. This is what everyone is very interested to hear. And I can see from your early comments that to downgrade your forecasts and talking about a dollar which will be under parity. This is going to be very interesting, of course, for everybody as to how this plays out. So let's move to Jim Vrondas, Head of Client Dealing at OzForex. Jim, if you'd like to give us your presentation, please feel free.
Sure, thank you. First of all, I guess a brief agenda as to what I'll be talking about, looking at the Australian dollar and some perspective on the volatility that we've seen. Bottom of that zone at 87.80 does open up the windows with some more downside, but obviously that's a long way from here. So moving on to the next slide, some interesting analysis that we did. We basically analysed some clients. Consist of SMEs and micro corporate clients. For those of you that are not familiar with OzForex, these are real money flows. This is money being moved internationally or from one currency to another. And with over 100,000 dealing clients, it does give us a good, I guess, barometer or feel for what the general market trend is. What this chart shows us is the dotted line being the Aussie dollar. As it rose and hit parity, we saw a big spike in demand for hedging, the Aussie US, as it reached and got through parity. However, the longer it actually stayed above parity, the hedging declined. We actually saw a 35% decline in demand for hedging in Aussie US during that period, whilst the Aussie dollar traded in a range above parity. There are a couple of reasons for that. One being
Muted.
With the increase in volatility in the market, the cost to put a hedge on increased dramatically. And the second one was also embedded expectations in the currency in the market that the Aussie dollar would remain above parity for quite a long time. Numerous stories about how the Australian economy would be shielded by what's happening overseas in Europe and the US, mainly because of our proximity to Asia. Now, since that, obviously, that's turned on its head somewhat, and the Aussie dollar has fallen below parity. And we've subsequently seen in the last few weeks, anyway, particularly last week, a big spike in demand for hedging products for Aussie US. So moving on to the next slide, just some simple high-level, I guess, strategies. The simplest strategies, I guess, for small businesses out there to employ either forward FX or forward foreign exchange or some vanilla options. Now, there are many other structures obviously available there. Given the short window of time that we have here, I'm not going to go into too much detail about those, but the important thing to note here is that most businesses have most, if not all, their costs fixed. The one variable that many businesses have is the exchange rate. So, you know, we often urge people to consider a hedging policy of some sort in order to look at fixing or minimising the risk that exchange rate volatility has on the business. So, you know, businesses should have a hedging policy, which is a written, living, breathing document, and one that should be kind of reviewed and constantly monitored. And one thing we do find is a lot of small businesses just don't have that level of, I guess, documentation to ensure that they take the emotion out of decision making and the risk is covered. So the two high-level ones and simple vanilla structures that I mentioned before, being FX options or forwards. There's a table there that lists, I guess, some of the differences between the two that businesses should consider. And an important thing to note also is that but it's a conscious decision not to hedge, and that's still fine. That's a policy in itself. But we're finding that in these times of uncertainty, some businesses just lack clarity around that decision-making process. So it's always wise to document what that strategy is, and every business being different and unique in its own way, it shouldn't be an off-the-shelf product, but something that's specifically designed by the business itself for itself. So that summarises my talk for today. Hopefully you found it interesting, and I guess we open up for questions now.
Wait, start again. Yeah.
Thank you very much, Jim, for that. It does cross some of the issues that are coming up on the screen from questions. Many questions, as you can imagine. The outstanding one, if I can, to some extent, put them together initially, which I'd like both of you to address, is the people are asking.
Start again.
Thank you for that. Thank you for that, Jim. The outstanding question I see on the screen from everybody, really, certainly the most commonly asked question in the session, is whether we will have a rally in the Australian dollar if there is a solution to the Greek situation. I'd like you just to shortly address that, if you could, both. Jim, I might ask you first, and Greg, if you could follow on. Will there be a rally in the Australian dollar? Should they actually achieve a solution to the Greek situation?
Well, our view is that there is likely to be a rally. The question is whether that would be sustained or not. The market has priced in and in some respects actually expects and wants a Greek default. I think they're kind of covered for dealing with that. However, the big question mark and the big negative is what that does to contagion throughout the region and the wealth for that matter, and the banks. So we think that if we did get a rally on that Aussie US, that it would be short-lived in any case.
Mm-hmm. Greg.
Well, if you look at where the currency traded up until, April this year, when the currency first headed to 110, really what the market was saying at that time was it was quite hopeful that European policymakers would resolve their crisis, which is basically a sovereign government bond crisis, which has spilled over into a banking crisis. There was considerable hope at the early part of the year that this would be resolved. And you also had the euro itself trading up near 150. Really since end of April, we're seeing this hope to sort of gradually continually fade throughout the rest of the year. And policymakers have made a number of missteps along the way. Now, clearly, if the market was to come to the conclusion this could be resolved, yes, it would be a dollar. But the problem really is that, to be quite honest, it looks sort of beyond that to an extent. It's not, the market's sort of given up to a large extent in hoping that policymakers will come to any sort of firm resolution anytime soon.
Oh, I suppose to put it in plainer words, it's probably unlikely that there would be a convincing solution, that we would get up some morning and find that there is a convincing solution that would spark such a clean rally. Though, of course, ultimately there will be a new construct perhaps around the euro by the time this is all over. A question here from Michael Keane, who asks both of you, is it the case that you have both downgraded your Australian dollar forecasts, and what is now the consensus? Again, I'd like you both to come in on this one because people would love to know what is the consensus, or at least the consensus range of the dollar in the year ahead. Greg, could you pick it up first, please?
I would say the mood has certainly turned much more negative for the Australian dollar, increasingly so over recent weeks. So I think that the mood, the forecast you'll probably read by a number of banks like mine are still catching up with the mood in the market, and I'd expect downward revisions to be coming over months ahead. But I'd say mood for the currency has certainly taken a more negative turn really since we started trading back down through one on a more consistent basis. I would say the forecast probably still for it to be somewhat stronger where it currently is now, but those consensus forecasts do tend to lag actual sentiment developments in the market.
Yes.
Okay, thank you. Yes.
It's an interesting point that you raised there, because our view is that we're at that point in the market. We're at somewhat of a reflection point where you do have some analysts already out there downgrading forecasts, and others, I guess, yet to follow, somewhat waiting to get further confirmation, I guess, of where we're heading. So at this point in time, you like to see most of the forecasts probably still above parity around the 105 to 110 mark, with a few in the mid-90s. So over time, though, if the Aussie dollar does settle around these levels or slightly lower, then, as Greg said, you'd expect forecasts to catch up on that.
Okay, thank you for that. And of course, we're restricting ourselves so far, as we often do, to a discussion about the US dollar. We have a question from Steve Collard. He asks, can someone comment on the future of the Australian dollar in relation to the euro? Which it does actually take quite a separate track, and very much so in this last few months. We'll just try Greg first. Greg, story entirely, but what would you be expecting to occur on that relationship?
Well, I think in the short term you've got to be careful that the Aussie actually falls faster than the euro does, and it has in fact done so really over recent weeks, and the reason is that I guess it does reflect kind of how high the Australian dollar went in the good period, and how many long positions were established over that time. I think the market's been generally sceptical about the euro for some time, and hence the Aussie dollar certainly outperformed the euro dramatically, the last few years, and it's sort of stabilised through the course of this year against the euro. I would be careful of that kind of clean-out move, but if I take a longer-term view of it, say, 6 months to maybe 2 years, that kind of time span, I think the Aussie dollar will continue to remain quite strong relative to the euro, and should eventually start to strengthen again, back to new highs against the euro.
I see. Okay, thank you. I have a question from R. McCarver, who is also asking, just specifically, again on this issue of turning it the other way around, rather than a resolution to the Greek issue. What is the probability of a default and the impact of the default on the AU and the US dollar? Well, that is the big question, the specific local question there. What would happen if there is a Greek default of any description or nature or dimension, I suppose we could say, including a partial default? What would the impact be on the Oz dollar and then on the US? And we might take that sequentially here. We might start with Jim.
Certainly, the default by the Greece in particular is somewhat, I think, being already predicted by the markets. We've got the futures, basically pointing at a 90% chance of a Greek default in the next 5 years. So I don't think that would come to a great shock. What would happen to the system, the financial system, would come under a lot of stress. I think the markets themselves can probably absorb the Greek loss or the write-off that would happen in that scenario. However, the banks that carry a lot of these debt on their books would be in a somewhat more fragile position, and some of the big banks should be fine. Don't think, as was evident in 2008, that officials would necessarily let any banks go under. I think they'll probably come to the fore and support those banks in order to stabilise the system, financial system. So initially we would get some fallout, and some banks, particularly the second-tier banks, might come under some severe stress. But I think that so long as that can be contained, and it's only Greece that writes off that debt, that things should stabilise before too long. In some respects, I think the market actually wants that.
Thank you. Looking at wider issues, we have a question from Eva To, who asks about purchasing property in the US, and this is a dimension, I imagine, of the business. We haven't talked about Australian shares yet, but she asks, in terms of buying property in the new year, by that I presume she means the new calendar year, what are the risks for Australian-based investors? This is something maybe, Greg, you might pick up on. Obviously, this has a corporate dimension in terms of REITs, but also many individuals looking at the US now. Some funds actually been launched in the same area about residential property in the US being put together for Australians. But what is the outlook there?
Yeah, well, I guess you've got two risks. Obviously, one is the property price itself, and the other is the exchange rate, assuming you're funding in Australian dollars. So you could have two choices there. You either borrow US dollars to invest in the US, in which case most of your risk will just be the property price in the US at that point, and you'll be funding yourself in US dollars. If you decide to fund yourself out of the Australian dollar, which I think is the easier way of doing it in terms of actually achieving, I know that banks in the US will be reluctant to lend to foreigners, but your Australian banks here are probably more able to lend to you, against other collateral such as your existing home. Then you run an exchange rate risk. You'll basically be running the opposite of the carry trade, if you like. You'll be paying a higher interest rate in Australian dollar to run the property or to fund the property, and you'll also have some risk on the exchange rate. So such that if the exchange rate were to rise, then obviously your property value, your asset, will fall in Australian dollar terms, but your loan will continue to stay the same. So they're the things you've got to be cognizant of. I mean, certainly it looks attractive from a long-term perspective because property prices in the US have fallen, between 30 and 40% on average since 2006, and the Australian dollar in a long-term sense is at around historical highs, although it would have been nicer to get it done above 1. So you've just missed out a bit there. so to speak, with this recent fall. Yeah, I think from a, I think it's an investment that certainly warrants looking at, and certainly if the currency were to go up again over the course, but even if you can obtain US dollar financing, US rates are at record lows. I think it's worth looking at, but it is a very long-term investment because there's still an enormous overhang in the US property market. There's a lot of foreclosed homes or homes that are close to being foreclosed. So the effective supply is still very high, and the US, some experts say, could take quite a long time, say another 5 years or more, before that supply in the market is cleared. But if you want to buy things which seem value, I think that US property is one of those.
Okay, thank you. Actually, there is a related question here, which is on shares. It's from Jim Sampson, who asks, will US-focused Australian shares automatically do better if we have a lower dollar? That's interesting because just this morning I did see a report which suggests certainly our healthcare sector, which is quite US-focused. We talk about companies like CSL, Ansell, ResMed, for instance, are all heavily engaged with the US, and some of the numbers suggest that they will immediately have a positive impact. I might ask you, Greg, on this one, about looking at the Australian stock market and the US focus which is there. If it's the case that you and your peers in the market are actually bringing down your forecast, and if it's the case that we find ourselves in something like parity or below parity in the year ahead, is that an automatic boost to some of these shares?
Well, yeah, generally you do see that relationship. Certainly if you looked at the performance of the Australian share market up until recently, it had significantly underperformed the US stock market, and the big part of the reason for that would be that the strength in the Australian dollar was curtailing profit expectations for Australian companies, particularly those competing with offshore producers or in export markets. And whereas in contrast, you saw the US stock market generally outperforming other stock markets because the US dollar was quite weak relative to other currencies. But you've got to take into consideration not just where the currency is today, but what are the expectations going forward. And I think one of the reasons why the Australian stock market has underperformed is this view now of the currency is not just going to fall back to its long-run average. It's going to remain at a relatively high level for a long period of time while we go through this resources boom, which could last for 3 or 4 years or longer. And hence, you've got to factor in a higher average exchange rate over the future. And I'm not sure that the stock market will react too quickly, just to this recent fall we've had in the currency, because it won't feel too permanent or one that will just continue on towards much lower levels. But certainly, those who are very directly selling into offshore markets, it will have caused some immediate impact on their near-term profits if they can, if the currency stays here for a little while. But obviously, the share price will reflect the expected return over a much longer period.
Yes. Well, thank you, Greg. So yes, what you said. Yeah. So this different level of our currency will automatically reflect in their earnings, but doesn't automatically reflect in their share price. And I suppose that's really that's the issue, whether the share market is convinced and whether anyone is convinced that we will remain at these levels. Okay, a wider question on the bigger picture, if you like. I might address this to you, Jim Vrondas. It comes in from a Nick Beams, and he wants to know about the CDS holdings, European CDS holdings held by the American banks. I think it would certainly be worth giving our audience some idea of what's actually occurring there, some sense of how the US and the US banking system is, if you like, ring-fencing itself and protecting itself from what's happening in Europe, and how that plays into the actual currency settings and the currency relationships. Jim, if you could pick up on that one, please.
Well, certainly there's some nervousness around, I guess, those CDS holdings. I mean, if you cast back to 2008 when we looked at the, I guess, the onset of that GFC, then these credit default swaps had a lot to do with how the US and the global economy found themselves in the predicament they did. Some would argue that what we're seeing at the moment is a repeat of that, but on a much higher level, given that we're talking about sovereigns and being short at that rate. So you look at what the money markets have to pay, or what European money markets and governments and so forth are basically having to pay in order to finance their operations. Those costs have skyrocketed, and hence so too, I guess, the credit default swaps, the CDS, in terms of ensuring those values. So we think that that's going to continue to be stretched until we see some resolution. We're not likely to for some time yet. So that's going to be an important factor, I guess, weighing on the US and the US dollar for that matter. The fact that the funding for US banks, not just in the US, but well, the US is actually not too bad at the moment given what the Fed's doing, but funding that they have traditionally been tapping into from Europe has obviously dried up in somewhat and become very expensive as well. So we're likely to probably see the euro continue to weaken as they look domestically, or the US looks more domestically in terms of financing, I guess, those operations as opposed to tapping into European markets. So I think that then just adds to the euro-US weakness.
Okay, thank you, Jim. A question here from Tom Burns, who asks, why is there so much attention being paid? And maybe you might take this up, Greg, in the wider context of currency markets. What is the issue with the French banks, and why are they so much in the frame at the moment?
Yeah, look, you know, at times through the course of this year, the market was called, well, this is just a European problem. This is just a Greek problem. You know, maybe those directly exposed to Greece, you know, maybe it's their problem. But the further you get away from Europe, it wasn't such a problem, and hence we had the currency in Australia reach its record high for the year towards the end of July, and this was really in the meat of this European crisis we've had. Why are we concerned about French banks? Well, French banks own a lot of Greek government debt, and they have a lot of exposure to other corporates in Greece. But not only that, the fear in Europe is once Greek potentially defaults, what are the implications for the next country? You know, what's the implication for Spain or Italy? And if these countries, you know, have difficulty funding themselves, well, then you've got a real problem. You've got potentially, you know, a banking collapse in Europe, because the exposure to these governments are so large and their corporates are so large, well, there's no way they can be just bailed out, right? So that's the real fear in the market. Now, for Europe is a big part of the global economy. European banks are large banks globally. You know, if they're in real trouble, well, then there's exposures that the US banks and other banks around the world have to those banks. In any case, you can't really rely on them anymore, you know, to come back to meet their obligations. If you can't rely on those banks to meet your obligations, well, it makes it difficult to get you to make obligations to other banks, and you get what you call systemic risk. A fear of systemic risk is what caused the global banking system to basically freeze up in 2008, and it required central banks to then do all the funding for the banks and to basically guarantee their borrowing so they could even do anything at all. And that's the real fear. It's contagion from one small country called Greece to other countries in Europe, to other banks in Europe, to banks globally, and then it becomes a major global problem. So that's why we're here worried about Greece, which is a very small part of the European economy, as the knock-on effects through the rest of the banking system.
Okay, thank you. And I'm trying to get through as many questions as we can. There are a wide range of questions, so we will bounce around on subject matter, but they're all good and they're all highly relevant. A question from Larry Quick. This starts off with, about petrol, and then asks a wider question of what will the impact of a lower Australian dollar have on petrol prices, and how will that in turn impact the economy? Now, gentlemen, we have talked about property and we have talked about shares. Well, could we have an attempt really perhaps to distill what a economy, and we can certainly answer the question on petrol too, but there is perhaps something of a view that it may not be a bad thing that if we have a lower Australian dollar, the mining part of the economy may not be quite so strong, but the rest of the economy, the non-mining and the manufacturing units within the economy may actually benefit, so that things are a little more evenly spread, even if in a slower growth context. I might ask both of you to pick this up. Maybe Jim, you could first of all pick it up. If we're sitting at a lower rate for the dollar, what would the impact be on petrol, and what would the impact be on the wider domestic economy?
Well, given that I guess global oil prices and crude prices are based and priced predominantly in US dollars, but also I guess in Singapore dollars, but US dollars in particular, then one would tell you logic would suggest that if it does, Aussie dollar does go lower, trade lower against the US dollar, that actual costs for buying, I guess, crude will go up for Australian dollars, for Australians. So one would tell you that would become more expensive. However, having said that, part of the reason, I guess, for that happening is also the risk aversion that we're seeing at the moment, the US dollar strength that's coming into play. So if that was to alleviate somewhat, then that wouldn't really have much of an effect at all. But theoretically speaking, probably likely to mean higher petrol prices here.
Yes, thank you. Greg?
Yeah, like, you basically you can't really think about one thing in isolation, because if oil prices are rising and the Australian dollar is falling, obviously that's in isolation. That is going to cause oil prices or gasoline prices or petrol prices here to be much higher, which will be negative for the Australian economy in isolation. But obviously there's so much going on. I think really when you think about the Australian dollar, often what you think about it as is a shock absorber for other things which are happening in the economy. So it's obviously good for the Australian economy now. The Australian dollar is falling because it will help to promote growth in the Australian economy, perhaps helping offset some of the weakness we're seeing in the global economy. But in doing so, at the moment, I guess, for instance, you're seeing both oil prices and the Australian dollar fall together. And often you see that happening. You see industrial commodities and the Australian dollar move in the same direction. And that's because they both tend to be kind of leveraged to the global economy. Would be the worst case scenario. That's when the price of oil goes up and it's got nothing to do with growth in the global economy. And that's negative for growth in Australia, as it is for every country. And but in that environment, you'd probably see the Australian dollar potentially fall, even though oil prices went up because of an oil shock. While it might make gasoline prices higher, it would also help profitability of Australian companies which are exporting offshore or competing with imports, and that would help employment and help the economy recover. So there's always other things which are going on, and it's difficult to say what one thing means in isolation.
Okay, thank you. Yes. Well, certainly some of the questions that are coming in, this issue of petrol has certainly taken off, and many people asking questions about that, which I suppose to some way is a proxy for the wider health of the global economy and the wider health of our own domestic economy. A very specific question here from Andrew Lyons. It's about the IMF and the changeover in the IMF in terms of the regime, moving on with the new chairman, of course, coming in to replace Trichet, which is Mario Baghi. He has come in and made a couple of statements in the last few days, not very encouraging, and certainly seem to negatively affect the market. But the question specifically asks from Andrew Lyons whether the new IMF chief will have an impact, and in what way that may affect currencies. Jim, could you take that one on board for us, please?
Certainly, I guess in that position, such a high-profile position, is a very important one. It's one that the market kind of looks to for direction, and in terms of policy settings and how things are likely to evolve, not just in Europe, but also Europeans' view on other parts of the world as well. So it is a very important position. It's a very high-profile position, as I said, and it's important also to note, though, that the chief Fed is not the sole decision maker in the process here, and although he may have some strong views of his own, most of the time he's a conduit for the IMF, I guess, to get the message and act to the market, not necessarily the chief decision maker. But obviously Trichet is a very hard act to follow, given his very high profile that's built in over time, and his strong stance on a number of factors. So the new incoming chief is obviously trying to stand his ground as well. What that means for the currency, I doubt whether it means too much in terms of a change in tact and a change in policy, and although we'll see some noise coming out initially, which will grab some headlines, I think the underlying view of the strategy behind what the IMF is trying to achieve won't change. So we could see some slight negative or weights placed on the euro. If you get any comments, going against the likelihood of any sort of resolution in Europe. But other than that,
thank you. One of the questions coming in is on the issue we've been talking all the time, of course, about hard commodities, invariably with the exception of petrol. But somebody is asking about soft commodities and what will occur to soft commodities in the year ahead when we're looking at a lower parity, lower level for the dollar, closer to parity. That's something I would like to pick up. Maybe Greg, could you outline some of your views on that as to what will the impact be for our soft commodities market, for our agricultural sector?
Well, agricultural commodities do have some connection with the global economy, global economic demand. You will see similar kinds of moves in things like cotton, and with oil and other industrial commodities. But they don't always react in the same way, and can also be affected by growing conditions globally, which can often be the more important determinant of commodity prices in the agricultural space. I'm certainly not an expert in that market, but you have seen some mild weakness across the agricultural commodity space over the last couple of months, not quite as much as you have seen in industrial commodities. And I think that is consistent with some ebbing in global economic demand. But as I said, there's those other key variables, which basically are growing conditions around the world, which I'm not an expert on.
Okay, thank you. And Jim, if there's anything you'd like to add to that, that's one of our final questions.
Certainly, I guess Australia's dependency on soft commodities is not as necessarily as headline-grabbing news as what it was with the hard commodities taking centre stage, but they're still very important to the local economy. Not necessarily as important, for example, in the big headline-grabbing news. When you look at New Zealand and its dependence on dairy, for example, that obviously has a major effect on the currency as well in terms of demand for dairy and what's happening with dairy exports. Agriculture exports from Australia do play a significant role in the currency, and in terms of being more competitive, I guess, throughout Asia, the drop in the Aussie dollar will provide a boost to these soft commodities.
Oh, very good. Okay. Well, look, thank you both for this, and just to our audience today, apologies for some of the technical challenges we had earlier. We had quite a few of them, unfortunately. And of course, we were also talking about the ECB with Trichet and Baggy, not the IMF. The IMF has its own issues, of course, in terms of recruiting. As we wrap up today's webinar, I would like to formally thank our panelists, Jim Vrondas, Head of Client Dealing at OzForex, and Greg Gibbs, Senior Currency Strategist at RBS, and our sponsor who made this event possible, the Commonwealth Bank. Also, thanks to you for attending and your involvement in today's event. We do appreciate it. Take the opportunity to provide us with feedback about today and send us some topics particularly that you'd like to see covered in the weeks ahead. We are doing these webinars very regularly, and we're always willing to respond to your suggestions. Of course, as we mentioned, for the graphics and the illustrations, if you had any difficulty with them earlier, we will be sending you a link and you will be able to see them later on. We hope to see you again at another of these sessions. Thank you and goodbye.